All right, let's dive into a topic that can make even experienced accountants scratch their heads: defer tax. I know, it sounds super complicated, but I promise you, we're going to break it down and make it totally clear. Let's get into it.
So have you ever been there? You're looking at a company's big, impressive profit number, but then you see their tax bill, and it just doesn't add up. Sometimes it's way lower than you'd expect. How is that possible? Well, there's actually a really good reason for it.
And that reason, the key that unlocks this whole mystery, is a little something called deferred tax. It's the bridge between the profit a company reports and the actual cash it hands over to the tax authorities in any given year.
So where does this all start? Well, the whole reason deferred tax even exists is because companies are basically living a double life. They have to play by two completely different sets of rules at the exact same time. And yeah, that's where all the confusion comes from, but it's also the secret to understanding it.
Here are those two worlds. On one side, you've got the accounting profit. This is their public face, the number they report to investors, calculated using financial standards like IFRS. But then on the other side, there's the taxable profit. This is the number they report to the government based on specific tax laws. And guess what? These two numbers are almost never the same.
And that gap, the space that opens up between the accounting world and the tax world, that's called a temporary difference. Now pay close attention to that word temporary. This is the most important part. We're not talking about if a company pays tax, it's all about when. It's purely a timing game. Okay, so let's look at the first scenario this creates. The best way to think about it is as a tax loan. This is what accountants call a deferred tax liability, or DTL. It's when a company gets a nice little break on its taxes today.
So it's a really simple chain of events. First, for some reason, the profit you show the taxman is lower than the one you show your investors. This leads to step two. You get to pay less in taxes right now. Awesome, right? But, and this is the big but, it creates an IOU. You now have an obligation, a liability, to pay more tax down the road.
Let's put some actual numbers to this to make it real. Imagine your company goes to its shareholders and says, "Hey everyone, we made an accounting profit of 100. That's the number that shows how well the business is really doing."
But then, when it's time to talk to the tax office, the government's rules let you report a much lower taxable profit, say only 70. Now, why would that happen? A classic reason is accelerated depreciation. The government might let you deduct the cost of a new machine way faster for tax purposes to encourage investment. So your taxable profit is low. You pay tax on 70, not 100. Great for cash flow today, right? But that big tax break is a one-time thing, and your tax bill will have to catch up later.
And that's exactly why the loan analogy is so perfect. You got a benefit right now by paying less tax. The government has essentially given you an interest-free loan that you will absolutely have to pay back in the form of higher taxes in the future.
Now let's flip this whole thing on its head. What happens in the opposite situation? This is when we get what you can think of as a tax credit. The official term is a Deferred Tax Asset, or DTA.
The process here is the mirror image of a liability. For some reason, your taxable profit is higher than your accounting profit. This means you actually have to overpay your taxes now. But the good news is that overpayment creates a future benefit, a credit you can use to pay less tax later on.
So for our second example, let's say your accounting profit is 80. This might be because you've booked an expense for something you expect to happen in the future, which is perfectly fine under accounting rules. But the tax authority says, nope, you can't deduct that expense until you actually pay the cash. Think about future warranty repairs. Accounting rules say, recognize that expense now. But the tax rules say, you only get the deduction when you actually fix a customer's gadget. So for tax purposes, your profit is higher, it's 100, and you end up paying more tax today because of it.
It really is like having a credit at the tax store. You've prepaid some of your taxes, and now you have a valuable asset on your books, a credit just waiting to be cashed in to reduce a future tax bill.
Okay, let's bring all this home. We've seen the loan, and we've seen the credit. Now let's tie it all together with one simple golden rule that governs this entire concept.
So let's boil it all down to its simplest form. A deferred tax liability, a DTL, you pay less now, but you owe more later. It's a liability. A deferred tax asset, a DTA, you pay more now to get a benefit later. It's an asset. When you see it side by side like this, it's pretty straightforward, isn't it?
And here it is, the golden rule, the single most important thing to remember from all of this. Deferred tax is all about timing. It's not a tax loophole, it's not a permanent saving, it is just a temporary gap between two different rule books that will always reverse itself over time.
And just like that, you've got it. By understanding that one simple rule about timing, you've just conquered a topic that trips up finance pros all the time. It's not so intimidating when you break it down like this, is it?
So I'll leave you with this to think about. We've just seen how a simple shift in timing can create massive assets and liabilities out of thin air on a company's balance sheet. It makes you wonder, where else in the world of finance and investing does the simple question of when completely change the entire game?